Right, brilliant. Thank you. Thank you, everybody, for attending this webinar this morning from Smales Goldie. My name is Peter Deering. For those who don't know me, I'm one of the partners at Smales Goldie. I'm joined by one of my colleagues, Alex Berridge, this morning from our corporate finance team. We're just going to be looking at the roadmap out of lockdown, how to navigate some of the challenges that we might all be facing, how to manage cash, forecast, etc., and look at some of the strategies that we develop with our clients in our blueprint team. I'm one of the leads on our blueprint advisory service. So just a quick rundown of what we're going to do today. First of all, Alex is going to talk us through just cash management in general. I'm going to look at business finance and what finance is available to businesses out there. Alex is then going to talk through the importance of cash flow forecasting. I'm going to touch upon a piece of our strategy sessions on pricing. And then at the end of the session, we've got a Q&A session. So if anybody's got any questions at all during this webinar, please use the Q&A function on Zoom. And at the end of the webinar, we'll answer all of those. So without further ado, I shall hand over to Alex.
Yeah, thanks, Pete. So my name's Alex Berridge, and I work in the corporate finance department at Smales Goldie. I've been there for around 3 years. So essentially, the topics that we're covering today is quite common that we'll see in our department. As Pete's touched on, I'll be talking about cash management and forecasting and how this can help you in your business. So to start us off with cash management, as businesses look to rebuild and recover from the recent COVID-19 pandemic in the coming weeks and months, it's very important that you've got a grasp on the good cash flow so the business can remain viable and you're ready to take on new challenges and opportunities. And in simple terms, it's a case of knowing your numbers and being on top of your business so that you can react quickly as to any changes and capitalise on new opportunities. There's several factors to consider when monitoring your financial health that will help the business survive. It's a good idea to start setting budgets for your business at least annually, although some businesses, if you've got the facility to, may benefit from reviewing numbers quarterly or even monthly to keep an eye on the figures so that you can make sure that any funds coming in outweigh funds going out. A good budget will factor in a degree of flexibility to allow the business to adapt to market conditions, especially given the current UK economic climate. Budgets that are too stringent can stunt business growth by not allowing the business to pursue opportunities that may arise. Of course, positive cash flow is also critical for the success of your business, as you need to be aware that problems can arise over investment, which can be with stock, employees, and fixed assets. So touching on stock, it can be a good idea for businesses to buy in bulk, which will obviously save money and get lower individual cost prices for units due to economies of scale. However, you've got to be aware that this can tie up a lot of cash in stock, and if you've got perishable goods, you need to consider this carefully. Another important factor is to consider employment costs. This is often one of the highest costs incurred by businesses, and there's usually a fine balance between having the right number of staff to service clients and run your business without overspending. And as a result of COVID-19, a lot of businesses have faced office restrictions and how the number of staff can actually service clients. So it's quite important to think if you could streamline any of your operations. Another consideration is if you've got the need to invest in new or replace capital assets, it could be worth obtaining a finance facility to spread this cost over the life of the asset as opposed to one large cash payment. Another important factor to bear in mind is managing customers and supplier payment dates. As recent research has revealed that late payment of invoices is the cause of 1 in 5 company insolvencies. So it's quite important that business owners have to think and look at who they want to do business with, both on the supplier and customer side. Overtrading is another factor which can cause cash problems, as if the business expands too quickly, it'll put pressure on short-term cash flow, which if there's predictable changes in trade and cash flow, this can cause problems. It's also you need to be prepared for any unexpected changes internally and externally for the business. Such internally could be such as loss of key staff, machinery breakdown, or external issues such as industry changes, trends, the global pandemic, of course, and any updating legislations. And moving on, forecasting and financial modelling can help a business review performance and, most importantly, review cash movements. A forecast will need to be as accurate and as comprehensive as possible. Just as importantly, identify any future points in time where cash will need to be managed. It's important to test any potential plans that you've got in the pipeline for your business on paper before implementing any costly changes, which should help you establish the financial implications of any of them plans. Preparing a detailed forecast will help you take these plans forward with clear-cut short and long-term action plans. Forecasts will help you to measure results, adjust strategies, and manage risks and keep the business on target, as well as improve coordination across different departments and motivate your team to work in towards a common goal. Alongside forecasts, regular, accurate management accounts can also help, as the management accounts will work alongside the forecasts to review current performance and historical performance versus the forecast, which is obviously predicting the future. So you can use these management accounts after the particular event of introducing new products, services, etc., to see how, if it's worked essentially, and how things could change to improve the business. On top of this, an effective bookkeeping system is essential for managing your finances. This is where you can combine in-house expertise and skills and capabilities of various cloud accounting software programs to tap into incredible business intelligence and help improve forecasts, management accounts, or whatever documentation you may need. An effective strategic planning process should involve an independent advisor to facilitate your discussions to make sure everyone participates in the process equally. An advisor, such as an accountant, will also explore the different views and opinions in the team, using them to enrich the strategy without derailing any discussions. The strategy development involves collecting and analysing data on clients or customers, competitors, and the financial performance of the company and any potential opportunities. Getting an impartial view on what this information means for your business brings new insights and ideas into the team. In strategy, pace is a key consideration, as building your business too quickly or too slowly can reduce your team's commitment to the plan and enthusiasm to implement it. A skilled advisor will also manage the pace of the team and equip them with the information they need to get the fundamentals right. And moving on, given the current economic climate, it is essential that businesses receive a steady inflow of cash as anticipated from the goods and services sold. For a significant proportion of small businesses, the biggest cash flow issue is likely to be late payments from customers. This is why the credit control process is a key importance of any business to maintain a healthy cash flow. It is often up to the small business owners to improve their credit control on their own, which can be challenging during difficult periods where you are trying to balance customer relationships with a need to get them paid. For new customers, performing credit checks prior to trading with a customer is an effective way to help manage risks of no payments or late payments. Credit limits should also be set with customers so that customers are aware that your business will not trade over a particular limit and encourage payment of current invoices. The credit control process should establish a realistic timetable, including all the stages that need to be completed by various team members within your business, and outline credit terms that should be based on the needs of your business. Once these elements are in place, the business can prepare a process for chasing payments, including a schedule for sending reminders, including initial prompts such as phone calls and emails. And on top of this, the accounts team within your business should review the aged debtors ledger regularly so that any old invoices can be identified and then the relevant chases can begin. You should also make sure that the business can offer as many payments options as possible. So this may include banks, credit card and debit card terminals, cash, online payments such as PayPal. Businesses struggling with late payments could also look to incentivise the credit control process by offering early settlement discounts to customers known for late payments. While this may seem like you are rewarding bad behaviour, it means that your business should get paid earlier, and you can also incorporate this into pricing strategies to ensure that margins are actually affected. Outsourcing the credit control is also another way to improve the chances of being paid on time. Obviously, there are anticipated costs with this. If you would like a hand in delving deeper into some of the numbers behind your business, please let us know. I'll now pass you back over to Pete, who will be discussing some finance options.
Alex, obviously one of the things that's inevitable now that COVID, hopefully we are at the end of the lockdown on businesses and the forced closure of businesses, it's inevitable that things are going to open up. It might be that your business has been hibernating effectively for the last year, just getting by. Obviously, as things open up, as Alex has already mentioned, as we trade more, there's obviously an inevitability that they will need more cash. And one of the ways to look for more cash is, and obviously one of the ways of looking at cash is looking at your working capital and what you will need. In an ideal world, the cost of doing business can be covered by the proceeds already undertaken or the goods already sold. However, we don't live in an ideal world. As I say, it's inevitable that we'll need some kind of funding. So what I'm going to talk about over the next 10 minutes or so is just what funding for business finance is out there, some of the things that you might have already taken over the last year and what options you've got for those funding, those things that you've actually taken out already. So let's first of all look at working capital. So what can you do to fund your working capital? The first obvious one is obviously speak to your bank about an overdraft. Overdrafts are generally becoming less popular. Banks see them as more risky. However, you might still be able to get one. Generally, they will want a debenture over the company, which is effectively a charge over any of the assets of the business. Another option open to you is debtor financing. This is whereby a finance house, a bank, etc., pays up front on an invoice that you've issued to a customer. It might be that you've given a customer 60 days credit, but the bank can effectively give you that money as a loan secured on that invoice as soon as the invoice is issued. Another option open to you is stock finance. Again, buying stock, you have a lot of money tied up in that stock. Banks can also finance or lend money secured on your stock. Stock finance is generally used more for buying from overseas. So, for instance, if you're buying something from China, it might be that it's on the water for 5-6 weeks. The bank can obviously finance that stock while it's on the water. Lastly, something that we're seeing more and more of is trade creditor finance. Quite a few companies now are partnering with finance houses to give their customers finance that they've secured for them, i.e. you buy something and you pay it over a 12-month period rather than within 28, 30 days. Other options then. When you are obviously coming out of lockdown, it might be that you need to invest. It might be that you need an asset. You need something to grow. You might have a property. Commercial mortgages are obviously one of the key ways that you can release funds in the business. If you haven't already got a mortgage, you could use a mortgage to effectively refinance your building. Those funds can then be used in the business to grow. General business loans, the banks are lending still. I will talk about the specific schemes in the next few slides. The next area where you can finance your assets is hire purchase and leasing, i.e. paying on a monthly basis rather than upfront for a large asset. There are other sources of business finance out there which I will touch upon. When you're a startup, it's quite common that friends and family may lend the business money. Obviously, that has its own risks. You would generally put some kind of agreement in place at the very beginning, because obviously any friend or family who are lending money to a business, a startup business, that money is at risk. External investors are another option open to you. There are schemes out there such as EIS and SEIS. These are tax advantageous schemes to encourage investors to invest in startup businesses. Crowdfunding is something else that we are seeing becoming quite popular. Generally, a business will offer something to somebody on the back of them lending or investing money into the business. It could be that there's a product they're buying, or it might even be equity. Peer-to-peer, another source of finance that we're seeing becoming more and more popular. This is an online platform generally that puts a lender in touch with a borrower. The platform takes a cut, obviously, on that, but anybody who's got some cash that they want to return on can use this platform to lend to businesses. Venture capitalist is the last option open to you. Very similar to an external investor, however, it's generally for larger sums. Moving on then, just touching on the business finance that you might have already taken. Obviously, one of the things that's been around while COVID was happening last year was the bounce back loans. These were the £50,000 loans open to most businesses. The government announced in the budget the pay as you grow option for businesses who've taken out these loans. What this does is enables you to extend the length of that loan from 6 years to 10 years. The scheme also enables you to have an interest-only element of that loan for 6 months that you can obviously negotiate with the lender. There's an option to do that 3 times during the lifespan of the loan. And lastly, the other part of Pay As You Grow is it enables you to pause repayments entirely for 6 months. All of these options, I would recommend that you speak to your lender who has lent you the money for the bounce back loan. Next, the CBILS loan, the Coronavirus Business Interruption Loan. So we are approaching the anniversary whereby people first took out these loans. So after the initial 12-month interest-free period, as we know, that will end. Lenders are obliged to provide businesses with an outline of the repayment costs for that loan, factoring in the interest. With a loan facility, it may be necessary to provide regular capital repayments, but lenders may be able to provide payment holidays subject to discussions with them. Obviously, in all of these cases, it's always key to talk to your lender early rather than later. Businesses can approach lenders to restructure the loan as well if they have issues meeting the prescribed repayment plans. However, the main thing is that if you are looking to restructure, you will need the financial information to be able to back up why you are in these difficulties. Where we are now then, the new scheme available to businesses, which was launched on the 6th of April and is in place until the 31st of December 2021, is what's called the Recovery Loan Scheme. You can apply for this scheme, again, if COVID-19 has affected your business, similar to Bounce Back and CBILS. And also you can apply for this scheme if you've already had a Bounce Back and CBILS loan. As I say, the scheme runs until the 31st of December 2021. This next slide is key, actually. It shows the differences between the CBILS scheme and the Recovery Loan Scheme. So the loan amounts are very similar. However, the Recovery Loan Scheme does enable you to borrow slightly more. The loan term, again, exactly the same. The key difference really is that the government aren't paying the first 12 months of interest on your behalf like they were for CBILS, and the government isn't going to be paying the upfront fees for you to get that loan. However, the guarantees element of the loan is still in place. So if you take a loan up to £250,000, there will be no personal guarantees required on that loan. One of the major advantages of this scheme, however, is that there isn't an annual turnover requirement like there was with CBILS. We see that this might be advantageous for companies who effectively are doing a lot of research and development at the minute before they start trading, and therefore turnover is very limited. So that's it for business finance. I'll pass over to Alex now and he'll talk about cash flow forecasting.
Yeah, thanks, Pete. So cash flow is a very important factor for running businesses. As not having sufficient money coming in and having too much money going out is a recipe for failure. During times of significant economic slowdown, such as what we've been experiencing recently due to the COVID-19 impacts, there's often been periods where businesses struggle with cash flow. To manage cash flow effectively, owners need to be able to forecast how the business will perform in the future. A well-prepared forecast can help to predict sales performance, estimate costs and spending expectations, indicate when cash will come into and leave a business, highlight pressure points within a business, improve credit control, and focus on the most successful services or product lines. As an idea, businesses should compile a 30, 60, and 90-day cash flow forecast as a minimum. A longer forecast can be useful, but they tend to be less accurate the further ahead they look. However, if your business has contractual elements to it, a longer-term forecast can be very useful. It's important to note that when you actually create a forecast, the forecast itself is only as good as the information being used to prepare it. So it's key to make sure that the information that's going into it is up to date and relevant. And also, preparing a forecast is not an exact science, as you're unlikely to ever get the cash balances right as to what's actually happened when you review the results. So it's kind of a trial and error process. And moving on, I'll just talk through the steps of the forecast. So in order to create a forecast, you'd first start by estimating your sales by being how much you expect to sell in a particular period. So if you planned on making additional sales in a particular product line or wanted to incorporate a promotion or special event, you would build that into the forecast. And at this point, we wouldn't include any tax on products or services sold, as we'll include this later on. From the sales forecast, you would then have to consider the direct and indirect costs that the business has. And from this, you'd be able to generate a profit and loss account, which would give you a projected profit figure for the year. Once you've got that figure, this can help you do a number of things. So you can calculate the break-even point. So you'd be able to calculate how many sales of particular services or products need to be made in order to cover fixed and variable costs. So from that, if you are falling short on a prediction of sales, you might be able to assess the pricing strategy, which people talk around. From the profit and loss account, you can also estimate how much tax the business will be liable for, gain an understanding the costs of launching any new products or promotions that you might have included, and then also gain an indication of loss-leading products and the first signs of negative cash flow, which you can then take action on. Following the inclusion of the regular costs, so you've got your profit and loss, it's also important to consider any potential one-off costs, such as capital expenditure. As I previously mentioned, to help manage cash flow, you could get some asset finance, which Peter's just mentioned. When you're preparing the forecast, in particular the profit and loss account, it's important to include costs in the months that you incur them rather than you pay for them. Because obviously, when we prepare the cash flow, you will look at existing data you may have on the cloud accounting systems. So you could look at when particular customers pay you, when you pay suppliers, and use that information to plot from the profit and loss accounts to generate a cash flow. And as Pete's discussed, there's various finance facilities that can be obtained by lenders. And typically, lenders would like to see a 3-year integrated forecast. So that would consist of a profit and loss account, a balance sheet, and a cash flow that all links in and balances together. So this is used by the bank to see if you can essentially keep up with the loan payments and afford to take the loan out in the first place. We're able to prepare integrated forecast models using software, which lets us change various elements throughout the forecast. And one of the key points of this is we're able to generate what-if scenarios. So, for example, with the click of a few buttons, we can change the sales growth in a particular year, add new product lines, change the gross margin, or even change the cash collection term sets with customers. And moving on, I will give an example of how we can change an assumption to affect the cash balances. So in this example, we'll look at how changing the cash collection terms with the customer impacts on cash. So on the top table, if we assume that company invoices £20,000 evenly throughout the month in the profit and loss account and has associated costs £15,000 a month. In reality, there would be further costs and overheads, but for this example, we'll just keep it simple. So looking at the second table, we've got the cash collection terms set with customers at 25 days and supply set at 25 days. So as you can see, the opening bank position of £10,000 is approximately worth £66,000 by the end of the year as a result of the year's trade. Moving on, however, due to external factors, the company predicts the cash collection terms of its customers will increase to 50 days, which can be changed in the forecast, and this will therefore produce a different cash position. As you can see, the bank position at the end of the year is now approximately £49,000 due to the delayed payments. However, in May, you'll see that the bank becomes overdrawn. And as a result of this, the company may need to consider sourcing a working capital source of funds, such as an overdraft, which Peter's discussed. This is a very simple example of how our forecasting solutions can be used to assist businesses assess the impacts that owners may face, and they might be able to plan for certain scenarios as a result of this. If you would like any help or assistance with preparing any forecasts, please do get in touch. Now I'll pass you back to Pete, who will talk about some pricing strategies.
Brilliant, thanks Alex. So yeah, just moving on then, I just wanted to share with you all something that we do in SG Blueprint. This is a particular tool that we use with regards pricing strategy. So coming out of lockdown, growing the business, it might be that it's time you look at your pricing strategy and look for areas where you can grow your business or potentially improve profitability. Most people know how to cost a product, but very few know how to price it. So we've got this model here which has got 5 steps to it to look at pricing. Step 1 is we look at cost plus, i.e. we look at what does it cost to produce a product, what the profit you want in that product is, and that comes out with the pricing. We then look at your competitors in your same market to see what they are selling a similar product for. We then look at what the market will bear for that product, for the price for that product. We look to see whether there's any regulations in your industry which affects the price potentially that you can place on that product. And lastly, we look at your pricing strategy and apply that to your marketing / business plan. So what I'll do then is I'll walk you through an example. So what I've got here is, let's assume that we are a manufacturer of a pen. We've got a rough idea of we've got a good idea, rather than a rough idea, should I say, of what the material is that produces this pen. We've got an idea of the labour and the overheads, and we know we want a profit in there. So in this example here, I've said the materials are 30p. The labour's cost for that particular pen is 20p. The overheads, the light, the heat, the rent, etc. is 30p. So it costs 80p to produce. However, I want 20p of profit. So my price is £1. Now, the big caveat here is that most people have done this. However, they've got it wrong. You really need to look at this step in a lot more detail than I've done here to try and really drill down to see what your cost of your product is versus the price. Step 2 then on this strategy is to have a look around and see, well, what are my competitors selling this similar product for? So if I've done that analysis now, and I've found that competitor A sells a similar product for £1.10, competitor B sells it for 90p, and competitor C sells it for 95p. Now, what I would say here is that you don't just look at that and say, well, we're more expensive, we need to make it cheaper. We need to look at what the market needs from your product, what the market can bear for your product. So that takes us on to step 3. What you do with your product is you look to see what benefits a customer gets from buying your product. So if we stick to this example of a pen again, what our model looks at is we say, right, our product has a score of 100. Where do we weight the key benefits of our product? So in this example here, I've said that my pen, I think that the key benefit to my pen is its durability. And I think that that's probably scores 50 out of 100. So I put that on my table. The customers perceive that the range of colours is about 20, the design is about 20, and then any other factors, it might be 10. So as you say, it comes down to a total there of 100. The model, the tool then says to us, well, let's take a midpoint of that, and that can be our benchmark on which we can compare our product with other people's. So that's exactly what I've done here. So everything there, I've taken half of it, comes to a midpoint of £1. We then compare our product to those same competitors. So let's say I'm looking at competitor C, the one who's got this pen for 95p. Well, their range of colours is slightly better than ours. So what I would say then is if our midpoint is 10, they possibly score 15. Their product is probably slightly more durable than ours as well. So they score better than us there. So we'll give them 30. The design, it's the same. It's the same product. So therefore, with the same, we'll score that 10. And the other factor as well, exactly the same, score at 5. So there we go. We end up with their pen scored 60 compared to our 50. We do exactly the same with our other competitors. And it immediately becomes apparent there that, hang on, we've got a bit of an issue here, because our competitor who's selling the pen for 95p is scoring more on the benefits to the customers or what the market will bear on that product than we are. So we need to look at it. We need to look at our products and what can we change. Before we do that, though, the key thing we need to look at is just to make sure there's no regulations in the market that affect what price we can charge. Does the government regulate the price? Is it a market price, i.e. something that's derived by world markets, i.e. prices of fish, prices of milk, etc.? Pharmaceuticals and healthcare, for example, as well, are another industry in which this step may apply, for instance, on the prescription charge. If you've got to this point and there is regulation on your pricing, really what you need to be looking at then is the cost side of your product, i.e. going back to step one. Let's assume in my scenario there that there isn't any regulations on the prices of pens. So we then need to look at what we can do. What can we do to drive strategy on our price? In any strategy, we look at the marketing plan. What is our marketing and business plan? Do we plan to grow the business? Do we plan to increase the profitability of the business? Or do we look to do both? In my example here, I'll assume that we're going to look to grow the business, but we want to maintain the profit in the current position. So what do? We know we've got a problem with this competitor C and their pen, which is 95p and is scoring more than ours on the perceived benefits to the market. We go back to step one, which was looking at the costs of it. Is there anything we can do in step one, i.e. can we drive efficiencies to reduce the cost but still keep our profit margin? Have we got the costings correct? Is there something that we need to change in there? Let's assume that was all fine. There is now nothing more we can do with step one. We now then need to look at the benefits to the consumer and try and change something here. So let's assume that without any extra costs, we can make our pen more durable. In fact, we can make it even more durable than competitor C. So therefore, we now score 35 rather than our competitors 30. We look at the range of colours. Again, without any extra cost, we can increase the range of colours to be at least the same as competitor C. As if by magic, we're now in a position whereby our pen has got more perceived benefits to the market. This was a whistle-stop tour of the pricing strategy, but you can see that what this does here is it will invoke within your team some challenges to what you already do, and look to always constantly improve. And this is something that you should be looking at every 6 months at the very least, just to make sure that your product, your pricing is correct. So that brings us to the end of the webinar. As I said at the very beginning, if anyone has any questions, please put them in the Q&A section of the Zoom channel on the bottom, I can see there's already a few there, so I will just get this one out first of all. So the first question is, can you clarify what type of businesses the recovery loan schemes are open to? The main criteria, the main eligibility criteria is that you've got to have at least 50% of your activity is a trading activity rather than investment activity. That is the main thing, the main criteria there. There's also criteria whereby you've got to be a UK company and you're not currently in a position of an insolvency arrangement. Next question, then, probably one for you here, Alex. I've used forecast before, but something unpredictable has always happened. What can you do to forecast when there's unpredictability?
Yeah, I mean, it's a good question. Obviously, it is quite difficult to do. But as I mentioned, there are always the what if scenarios. So, you know, how we touched on how you could change, you know, your gross margin, or you could account for a particular production machinery running down so you can produce products, how that might impact you. So, yeah, just running lots of different scenarios through the forecast is a good way to plan for that. There's another idea as well. You could include like a contingency cost line in the profit and loss account, and obviously that'll pull through to cash flow and paid, which can help account for unforeseen expenses as well.
The last one I've got here from me probably is, I have taken out a Sybil's. Can I also take out a recovery loan scheme? And the answer is yes, there you can. Obviously, the bank or whoever the lending institute will be looking at how much you've already taken out and looking at affordability. But yeah, you can definitely take one as well. Last question here. I only prepare a profit and loss forecast. Do I need to create a balance sheet and cash flow statement as well when I forecast?
Yes, the answer would be yes, essentially, just because the more information that you've got to hand, the better you can analyse and monitor the performance of obviously how the forecast has come together and what plans you've put into the forecast and assumptions. So it'll help you track any business decisions you've made more effectively. And it'll also depend on the end user of the forecast. So, for example, when we touched on how if you raise a source of finance, a bank would like to see the profit and loss, the forecast, and the cash flow statement as one forecast. So, yes, I think so.
Brilliant, thanks, Alex. Well, we've got no more questions that have come through. We're slightly ahead of schedule there, but I will let everybody get back to their busy day. I'm sure everybody's busy at the minute. So lastly, I just want to thank everybody for attending our webinar. This is the first in a series to do with the roadmaps out of recovery. There'll be two more in the coming months, so keep an eye out, and we look forward to seeing you soon. Thank you very much.
Thanks, everyone.
Bye-bye.